When everything is uncertain around you, where do you put your money, right? Markets, geopolitics, interest rates, everything is in flux as we speak. So, with interest rates, a stock market sell off, geopolitical conflict, or a recession scare, multifamily has proven over and over again that it holds up better than any other asset class. Today, we're going to break down why that is with real data, real history, and real talk. So, really excited to dive into this topic today. If you're interested in learning more about what we do here at Ferris Capital Partners, go to fulloutinvesting.com. There's a sample deal deck, a 1 hour video that explains our 10-step process to finding the best assets with the goal of doubling your equity in 5 years. And you can also book in a time to talk with us. So, let's set the stage a little bit here and why uncertainty matters right now, right? So, the U.S. strike on Iran on February 28th, that is still ongoing, has rattled the markets. Oil has spiked and geopolitical risk has elevated. We've seen the stock market very volatile. It's just up 0.5% year to date in 2026. And I'm saying that on March 10th, right? And it's probably fluctuated by the time you're listening to this episode. They do come out a little bit after we record these, right? So you also have the fact that we have AI disruption happening today. Now, a lot of big companies are laying people off, the Amazons and the Googles, and they're saying it has to do with AI. If you kind of peek behind the curtain, there's a little more to that story. In fact, what it really boils down to is during the pandemic, there was a fierce competition for talent because the job market got so tight and unemployment dropped so dramatically that a lot of these big companies actually overhired. And so I think a lot of this disruption and this laying off that we're seeing is really more a reaction to that. And it's just a little more convenient to say, oh, it's AI than it has to do with we just made a mistake and hired too many people. A lot of people are saying this. This isn't just my thought, but the data does sort of back that up. But we will continue to see potential AI disruption, right? So, the tariff uncertainty, right? The Supreme Court struck down Trump's tariffs. He's now said, well, I'm going to use this act to do it. And so we're still in this kind of like, what's really happening with tariffs and are they legal? Are they going to be applied? And what happens if the US has to pay back those tariffs to the companies that paid them, right? So we've got a lot of things happening there. And we're also in a bit of limbo with inflation, kind of interest rate, right? So if inflation starts to increase due to this, issue in Iran, we're going to see inflation persist, which means the Fed may pause future rate cuts. And so we may find ourselves in another period of stagflation, bottom line. So a lot of our investors are asking us, like, what do we do? Like, how do we, protect ourselves in this situation? And what actually like holds value regardless of what's happening in this uncertain political climate. So we're going to dive into that today. So multifamily, we think there's like 6 pillars of resilience that multifamily has, and we're going to talk about each one. Now, number one, people always need a place to live. Housing is a basic human need. It's not discretionary spending. It has to happen. Generally, if somebody's not paying their rent, it's because something very extreme has happened in their life. It's usually the last thing that they're willing to sort of not pay, right? So that is a big part of it. And unlike office, retail, or hospitality, demand does not disappear simply because of a downturn, going back to that basic human need. And so when you're looking at B class assets like we acquire, we often see that a class A resident will bump down to a class B to save a few $100s in rent on their upcoming renewal if they are fearful or have maybe perhaps had a loss of income. So national occupancy averaged 94.7 throughout all of 2025. That's through rate hikes, supply surges, and geopolitical noise. So we've already shown that resilience in light of everything that has been going on the past few years, post pandemic and post the new Trump administration. Pillar number two, there's just like a structural housing shortage in the US, right? So we're chronically underbuilt. Shortage of housing is a long term structural problem. It's not cyclical. It's not just something that's happening right now. It's been happening for years. Depending on who you ask and which study you're looking at, we're somewhere between 4 to 6 million single family homes shy of where we need to be just to meet the demand of the buying population. We've also seen the average first time home buyer go from 27 to 28 to 40 in just the past few years. So the housing shortage crisis in the US is keeping people renting longer. And even with the new supply wave we saw of apartments coming online, the deliveries have now sharply fallen off, and we're going to start seeing a normal flow of new apartment buildings being built. But then you add to that, okay, if oil prices have increased like they have, that means building material costs are going to increase, and it just becomes even more harder and challenging to build a new apartment building and get the rents you need to turn it into a profitable deal. So less supply plus sustained demand equals landlord pricing power coming back. And so Marcus and Millichap, right, even at its peak, national apartment vacancy at its peak and projected to gradually decline through 2026. So we're going to see more and more people renting once again. So that vacancy is going to continue to decline. We'll see more and more people purchasing. Price Waterhouse Cooper released Real Estate Trends, Emerging Trends of 2026. And in there it said, investors believe in multifamily long-term growth and stability. Starts are plummeting during a long-term housing shortage. And if you have capital lined up when the price is right, you want to invest. So this is coming from Price Waterhouse Coopers. Now, pillar number 3, home ownership is increasingly out of reach. I touched on that stat around the average first-time homebuyer age growing by 12 years from 28 to 40 in just the past few years. Average new mortgage payments today are 35% higher than the average apartment rent. So it's just becoming harder and harder to buy. More and more people are renting. The median age of that first-time home buyer, as I said, is 40 in 2025, the highest on record. And by late 2025, the cost of home ownership was nearly 3 times higher than the average apartment rent. So with high home prices and elevated rents, millions of households are staying renters longer than they plan. Pillar number 4, inflation hedge is sort of built into the asset class itself. So we typically have these 12-month leases in multifamily, and at Ferris Capital Partners and our Ferris Residences apartment brands, we will only do a 12-month lease. We don't do month to month. We don't do shorter term leases. So we have the ability to reset rents with inflation every single year. And unlike long-term commercial leases that often have lease rates locked in for 5 to 10 years, we can reprice annually. And then that replacement cost of building new apartments rises with inflation. So existing assets gain intrinsic value because as that cost building comes up, it pulls up the values of those already existing buildings. In fact, Invitation Homes, who was a client of ours at my prior company, Mark Spain Real Estate, bought 100,000 plus, hundreds of thousands of single family homes during the Great Recession. And what blew me away when they first kind of knocked on our door was their number one metric was the discount to replacement cost. You would think it'd be, what's my cap rate? What's my return? What's the rates going to look like? What are the rental rates going to be? It was all about the discount to replacement cost because they knew when home building started again, it would pull those values up. So it's a metric we look at on every single deal we do here at Ferris Capital Partners. And so incomes do also tend to grow with inflation, and our debt stays fixed at the property level, right? So the math gets better over time. So, as we raise our rents, we're getting more NOI, but our debt is a fixed rate, so we're getting a better deal. Pillar number 5, investor demand and capital market strength. So, according to Price Waterhouse Cooper, multifamily is the highest rated investment prospects among all core CRE property types heading into 2026. MSCI, 2025 apartment investment volume expanded in 2025 to $165.5 billion, which was the second consecutive year of expansion. And it's above the 15-year average of $155 billion. So you can see the markets are reacting and they're saying multifamily is where we want to be. And agency lending has surged. So Fannie and Freddie have actually opened up and they're taking down more deals. They've increased the volume of deals they plan to do almost exponentially. So it'd be easier to get that financing. Now, of course, we're going to have to factor in rates and all those things and leverage and like structuring the right debt for the right deal. And that is a challenge, but the capital is there is the bottom line. And so multifamily rental households hit an all-time high in 2025. Up to 22.4 million. So going back to Price Waterhouse Cooper report, multifamily has long-term investment profile head and shoulders above other property types. Now, pillar number 6 is the B class specialty, which is what we do. That's the sweet spot. So Class B workforce housing is outperforming all other multifamily segments right now. We're seeing more stable occupancy, lower vacancy sensitivity, and stronger renewal rates. In many markets, 55+% renewal rates. We actually target like 65 to 70, but just shows the resiliency of Class B. And institutional capital is increasingly targeting Class B and C assets for their resilience. In fact, we just lost the deal to a large institutional investor And even the broker was shocked. They even made an offer. He said, this is not their normal thing. They normally target, class A. And so he was actually a little reluctant to suggest the seller take it just because it's so outside of their normal buying pattern. But it kind of shows that some of these groups are starting to make that decision to switch into class B. So that's exactly where we operate. We're not class A luxury. We don't want to have the most expensive rent in the area. We want to be right in the middle, offering something that feels super valuable, that's just in great condition, has exceptional amenities and high quality units at a more affordable rate. So, how's multifamily held up over the years, right? And we're going to kind of wrap it up here. So versus the stock market. So the S&P 500, high volatility could drop 30, 40% in a crash with no income floor. Multifamily is an income generating asset. So even if values dip because of cap rate expansion, rent checks keep coming in. So we can wait for better timing when we start to see some cap rate compression to exit at the right time. 90% of millionaires, this is a quote we talk about all the time, but it's a true statistic. 90% of millionaires built wealth through real estate, not stocks. And if you look at this is one will blow you away. Real estate equals 60% of the world's mainstream assets. It's about $280 trillion more than debt and equities combined. So higher returns than stocks historically with lower volatility. It's really the best of both worlds. So we can look at some recent cycles. COVID-19, multifamily held occupancy, government support kept renters in place. We saw a rate hike cycle from 22 to 24. Values did compress, but income held. So if you had fixed rate debt, you survived no problem. Those with floating rate debt were challenged, just to be clear. But that was a strategic decision that was made that in hindsight, always being 2020, it was a bad decision. But it's why at Ferris Capital Partners, we only do fixed rate debt. We saw a record supply wave in 24 and 25 with 550 to 600,000 new units being delivered, yet national occupancy held at 94.7. And that absorption story, is just truly remarkable, right? Demand consumed one of the largest supply waves since the 1970s. So looking at other asset classes, office, it's like in an existential crisis mode right now. You got remote work, AI disruption, rising vacancies. Some operators are actually trying to convert office to multifamily and finding some success, but it's very expensive and very difficult to do. Offices just weren't built with multifamily in mind. There's typically like, one or two bathrooms on each level, right? So you have to figure out how to get plumbing to all the units. And so it's not just like, oh, let's just go in and add them some walls, right? It's a bigger lift. We will see more of that, but it's not going to be easy, and it certainly isn't easy. Retail, ongoing structural decline as e-commerce continues to disrupt and erode brick and mortar. Hospitality, it's the first to suffer whenever there's sort of any geopolitical or economic shock. Travel stops, right? People just don't, go on vacation as much anymore. Industrial and logistics, I'd say they're solid, but that tariff supply chain risk, and then you add to that what's happening now with Iran, you might see some challenges there. But multifamily, people need a housing regardless of what's happening in the world. So if you've enjoyed this episode, thanks for listening. Please subscribe, and share with another high net worth investor that you think could benefit from it. Thanks for tuning into the Multifamily Investor Playbook. We love and believe in you guys. Keep dreaming and investing big.